Welcome to Retirement Income Options, Personal Sources. Canada's retirement income system is made up of three sources: workplace, federal, and personal. Each of these income sources may contribute to your total retirement income. Your personal sources of retirement income will mostly be comprised of any money you have in registered retirement savings plans, RRSPs, registered retirement income funds, RRIFs, tax-free savings accounts, TFSAs, and any regular non-registered savings accounts or investments and employment income. Let's take a closer look at registered retirement savings plans, better known as an RRSP. RRSPs are a great option to help you save for retirement. The money you contribute to an RRSP is tax deductible. The contribution lowers your taxable income in the year the contribution is made. You can also contribute to an RRSP in your spouse's name. This is called a spousal RRSP. The higher income spouse makes the RRSP contribution and receives the tax deduction, but the RRSP account is in your spouse's name. By doing so, you can save income tax in retirement if your spouse is expected to be in a lower tax bracket than you. There is a limit on how much you can contribute to an RRSP each year. For instance, you can contribute 18% of your previous year's earned income up to a maximum of $32,490 for 2025. Each year after you file your tax return, you will receive an RRSP contribution room statement on your Notice of Assessment from Canada Revenue Agency. There are a variety of ways to invest your RRSP contributions, such as high interest savings account, GICs, term deposits, mutual funds, bonds, and equities. Check with your credit union or financial institution for your options. The investment earnings you receive from the investments in your RRSP account are sheltered from income tax if they remain within the RRSP. However, since you receive a tax deduction on your RRSP contributions and your investment earnings have been sheltered from income tax, once you withdraw any money from your RRSP, the withdrawal is included in your taxable income for that year. You can only hold money in an RRSP up until the end of the year you turn 71. Sometime before then, you must collapse or cash in your RRSP and pay income tax on the entire amount. Or you can convert your RRSP into a registered retirement income fund. A RRIF allows you to have the money you accumulated in your RRSP paid back to you over a number of years. You have the flexibility to decide how quickly you want to spend this money. However, there is a minimum amount you must withdraw each year. You only pay income tax on the amount of money you withdraw from the RRIF each calendar year. There are various types of retirement income accounts available at credit unions or other financial institutions. As previously mentioned, your RRSP will convert to a RRIF in the year you turn 71. A prescribed RRIF, a PRRIF, or a life income fund, LIF, are accounts created from funds that were previously in a pension fund. A PRRIF only applies to pension funds from Saskatchewan or Manitoba. All of these accounts will have minimum withdrawal requirements in the year after you open the account. Each type of account has different rules. For example, a PRRIF has no maximum withdrawal restrictions, while a LIF will have an annual maximum withdrawal amount applied each year. Some jurisdictions allow you to unlock a portion of your account. It is important to find out what rules apply to the type of account and if unlocking or maximums will apply to you. All monies withdrawn from any of these accounts are taxable income. Now that we have talked a little bit about RRSPs and retirement income accounts, let's take a closer look at tax-free savings account, also known as a TFSA. A tax-free savings account is somewhat similar to a regular savings account. TFSAs were introduced in 2009. It is an investment vehicle that allows you to contribute and earn income tax sheltered. You must be at least age 18 to contribute to a TFSA. There are limits on how much you can contribute to a TFSA. The maximum annual contribution limit for 2025 is $7,000, with an accumulated total of $102,000 since inception in 2009. Any unused contribution room is carried forward, so if you have never contributed to a TFSA, your total accumulated contribution room is $102,000. Similar to an RRSP account, there are a variety of ways to invest your TFSA contributions. Check with your credit union or financial institution for the investment options available to you. You do not have to pay income tax on the investment earnings or interest you receive within your TFSA. When you make a withdrawal from your TFSA, it is not considered income, so you don't pay any income tax on it. The amount you withdraw is added back to your contribution room the following year. TFSA, if you have a spouse, your account can have them named as a successor holder, which does not affect their contribution room and has no tax implications. The funds in the TFSA can also be left to a beneficiary or your estate with no tax implications. RRSPs can be transferred to your spouse, allowing for tax deferral with no tax implication until the funds are withdrawn by the surviving spouse. If you do not have a spouse, the RRSP can be paid to a beneficiary or to your estate. In either event, the estate will be responsible to pay the applicable taxes owing. LIFs or PRRSPs can also be transferred as a spousal rollover, with no tax implications to the spouse until withdrawn. If you do not have a spouse, or if a spousal waiver is signed, you can designate beneficiaries or the estate, and the estate will pay the income tax. Each jurisdiction has an applicable definition of spouse. Now that we understand a little bit more about RRSPs and TFSAs, let's take a quick look at non-registered savings and investments. Non-registered savings and investments do not have any contribution limits or age restrictions. The money you put into non-registered savings is from after-tax dollars. In other words, there is no tax deduction for contributing to non-registered savings. Interest and dividends are taxable in the year they are received. Any capital gains are taxable in the year they are realized. When you make a withdrawal, it is not included in your income and therefore is not taxable. There are a variety of ways to invest your non-registered savings. Check with your credit union or financial institution for the investment options. Thank you for watching our video. If you have any questions, please do not hesitate to get in touch with us. We're here to help you make an informed decision.